The company's bonds have already tumbled to their lowest levels on record. But why is this important? Here's why you should care. China Evergrande is an enormous company in the world's second largest economy. It has a market value of $44 billion USD, which makes it bigger than Australia's BHP Billiton or Rio Tinto. Its debt burden is higher than Apple Inc., Microsoft Corp., and Google's parent Alphabet Inc. combined. Its stock price has roughly halved this year, making it one of the worst performing stocks on global markets. China Evergrande is now trading on just 3 times forecast earnings, versus a multiple of around 10 for blue-chip property peers like China Overseas Land and Investment Limited, or COLI, and Country Garden Holdings Co. Limited. That suggests investors are pricing in a very low probability that the company can ever pay off their debts. China Evergrande Group is in serious financial trouble. The firm has over $100 billion in debt, and the company's chairman, Hui Kaiyan, has pledged to repay nearly half of it by September. In early June, the Hong Kong-based firm sold a massive majority stake in its electric vehicle unit, Evergrande Health, for $10 billion. But as Bloomberg notes, that windfall likely won't be enough to spare the firm from a looming debt crisis or Beijing scrutiny. Here's what you need to know about the crisis at China Evergrande and why it matters for China's economy. According to our statistics, only a small percentage of you who watch our videos are subscribed to our channel. If you have not yet subscribed, please hit that subscribe button, as it helps to promote more of our content. Thanks! The story. Evergrande is a real estate empire with fingers in many pies. It is China's third largest property developer by sales and the second largest by total assets, a position bolstered by an aggressive expansion in recent years, and has developed numerous high-profile residential and commercial developments in first-tier Chinese cities like Shanghai and Guangzhou. How can it hamper the global finances and capital markets? Evergrande has taken on a huge amount of debt to fuel its land acquisition and construction spree. The company has issued dollar bonds worth $23 billion in the past few years and raised more than $10 billion through syndicated loans from banks such as Goldman Sachs, Morgan Stanley, JP Morgan Chase, and Citigroup. The company also uses a lot of short-term financing to fund its expansion plans. This is risky because such funding can be withdrawn quickly if lenders sense trouble. And there have been rumors that some offshore banks have started to shy away from lending to Evergrande amid concerns over its high leverage levels. Evergrande has about 1 trillion yuan, or $155 billion of short-term debt coming due this year alone. However, the company insists that it is not facing any liquidity problems. Evergrande doesn't just build and sell properties, it also operates 2 football clubs, Guangzhou Evergrande and Tianjin Quanzhan, and owns shares in the UK football club Southampton FC as well. The Chinese property giant Evergrande has a huge problem. It takes on new debt to repay existing debts, but this is becoming increasingly difficult as China's economy slows and the company's creditworthiness declines. If Evergrande fails to repay its debt, this will have large repercussions for the rest of Asia. The contagion risk is increased by the fact that other Chinese property companies are also in trouble. Evergrande is the largest real estate developer in China and one of the top 5 in Asia. It's also the largest holder of debts owned by Chinese companies and has more than 1 trillion yuan, or $1.1 trillion, in liabilities. The company has been under pressure since last May when it issued an unusual statement saying that its liquidity was reasonably sufficient. This led to a sharp fall in its share price, which lost more than 80% of its value over 6 months. The company said it had enough cash to repay all of its debts and would not need additional funding until 2020, but the market remained unconvinced, with shares continuing to slide despite reassurances from management. It did not help that Evergrande had a highly leveraged balance sheet, with total liabilities about 3 times the equity. Evergrande, the world's most indebted property developer, is facing a severe cash squeeze as its mounting obligations collide with a cooling Chinese real estate market. The giant Guangzhou-based company is one of the most prominent examples of how China's debt booms have pushed companies to the brink. The company is one of China's largest property developers and reported $100 billion in assets at the end of last year, according to Bloomberg. Its share price has dropped by about 25% since early January. Evergrande said in an exchange filing on Sunday that it was facing a serious liquidity crisis. It needs to repay or refinance about $19 billion this year, but it only has $3.2 billion in liquid assets, according to Reuters. If Evergrande can't pay its debts, it could have major implications for China's already slowing economy and Hong Kong's real estate market, but it could also reverberate around the world. It isn't the government-owned developer that has been in the news recently, China Evergrande Group, but a privately owned one, China Evergrande New Energy Vehicle Group. The difference doesn't matter to nervous investors on China's stock markets. Shares of Evergrande have fallen 40% in Hong Kong and 50% in Shenzhen over the past 3 months. The company's Hong Kong listed shares dived 6% Monday after it suspended trading for 4 days. Evergrande's fall from grace demonstrates just how brittle China's financial system is, with a single company's debt woes threatening to trigger a market meltdown. Here's 5 reasons you should care about what's happening at Evergrande. It is the most indebted company in the world, but you've probably never heard of it. Evergrande Group, a Chinese property developer with a $54 billion debt burden, has overtaken the likes of Deutsche Bank and Barclays as the world's most highly leveraged company, according to Bloomberg. The firm is currently carrying $3 of debt for every $1 of equity, which is more than double the ratio recorded at the start of 2016. While it might be tempting to write off Evergrande as an anomaly, investors should pay close attention to what happens next. While China's debt-to-GDP ratio sits at a relatively modest 255%, it masks significant pockets of risk within selected industries, such as construction and steel. What's more, Chinese economic growth continues to slow while government's capacity to mitigate risks is constrained by rising levels of indebtedness. As such, a large number of corporations are facing an uphill battle when it comes to refinancing existing debt or raising new funds. The company is also one of the most popular shorts for hedge funds in Hong Kong. Now, a new report from Nomura says it may be too late to short the stock, but not because Evergrande is going to suddenly get its finances in order. The report says that the risk is that if and when the bubble bursts, it could lead Chinese banks to suffer massive losses, creating a financial crisis in China. Nomura's China economist Ting Lu writes, "We have found that Chinese banks' exposure to Evergrande is enormous, especially for trust companies, and could create systemic risks if Evergrande defaults on its debt. We believe this sets up a risk-reward scenario where shorting Evergrande may no longer be attractive given its low valuation and high liquidity. The company's bonds have already tumbled to their lowest levels on record. Here's why you should care. China Evergrande is an enormous company in the world's second-largest economy. It has a market value of $44 billion USD, which makes it bigger than Australia's BHP Billiton or Rio Tinto. Its debt burden is higher than Apple Inc., Microsoft Corp., and Google's parent Alphabet Inc. combined. Its stock price has roughly halved this year, making it one of the worst-performing stocks on global markets. China Evergrande is now trading on just 3 times forecast earnings, versus a multiple of around 10 for blue-chip property peers like China Overseas Land and Investment Limited, or COLI, and Country Garden Holdings Co. Limited. That suggests investors are pricing in a very low probability that the company can ever pay off their debts. Evergrande is the world's most indebted company, with debts of nearly $120 billion. This has set off alarm bells among analysts and investors who worry that the company could be in danger of defaulting on its loans. In the event of a liquidity crisis, it would not be easy for Evergrande to pay back its debt, said Andrew Collier, managing director of Orient Capital Research. It simply doesn't have the cash. The debt crisis at Evergrande is being closely watched around the world. If a debt crisis were to occur, it could affect some of the largest banks in China, as well as banks and investment funds around the world that hold bonds issued by Evergrande. The Chinese government may step in to help Evergrande pay off its debts if necessary, but this is also worrying experts because they say it would send a message to other companies that they can borrow as much money as they want without fearing repercussions. Evergrande's debt problems touch on a lot of other issues that are both economically and politically sensitive, and which we can expect to be in the news for some time. 1. Evergrande's is only the first of many potential corporate defaults in China. Evergrande has been able to raise money by issuing bonds because it is considered too big to fail. But Chinese companies generally are running out of collateral and are being forced to borrow from the shadow banking sector at higher interest rates. 2. The Chinese government won't be able to bail out everyone who needs help. 3. Soaring corporate debt has become a big issue for developed countries as well as emerging markets. 4. China is trying to deleverage its shadow banking industry, which will cause problems for borrowers who have been relying on it. 5. The new, more conservative approach to lending could lead to slower growth in China and other countries that rely on Chinese demand. Evergrande's debt situation is no laughing matter. The company has taken out a significant amount of debt, and there are fears that the company could default on its loans. But the question is, what can be done, and who will protect the interests of the investors?